Hi there, Alpha Team. This is the preview video for the 15th of April 24. We'll be discussing it on the live show later, but this is to go with the PDF. Obviously, lots happening last week. We had our winner, didn't we, of the Rolex on Friday, Dion Kenink. And amongst that, as you can see from the chart on gold, we had all sorts of shenanigans after he'd had his wonderful benefit. And I talked on Friday about putting in that trend channel from the minor 1 and 2 trades through the bottom of the range, through there with the minute 1 and 2 wave, left it in place, and look, we went and took out the top, straight back into channel, all the way through and down to the bottom. So there's every chance, as we talked about before, Elliott wave gives you a way of looking at the market in sentiment terms. And was that the fact that the market baked in what was the most signposted bit of geopolitics for a long time? Iran needed to make a statement, but they didn't want to escalate to DEFCON 1. It couldn't have been better flagged if Israel were the ones pressing the button for the attack. Everyone was safe. There was only one injury, wasn't there? A little girl. Hopefully she's okay. But that was classic regional posturing like it used to be. A slap across the face for Israel, calm down, and it's about time they did for a while. So it'd be interesting. So from that, we're expecting it to cross the channel. Does that mean, and is that going to be symptomatic of what the week ahead is? Are we putting in 3s and 4s like we've been looking for, in which case we're back into the channel, moving up towards the 2,500 plus area on gold? Well, I'm going to talk about a number of things today. The indices equally, there's a lot of negativity baked in already. We've been talking about being in wave 4s. We're now into earnings season. That's got quite a low bar for the US particularly, and the Mag 7 are expected to come in with a hefty upside of 38%. The market as a whole, I think, in the States is only 3.8%. That would be quite a low ball figure for Q1 versus previous years. So let's see how we get on with that. I'm going to take you through what's coming up this week. As usual, an in-depth sort of diary type review of what happened with the talking heads and each day as it went by for you to peruse. We'll go over the major points that have come out of that. But I've also got an in-depth look at what could actually be going on in gold, with quite an outlandish idea that we may possibly be on the way to a proper revaluation of gold. It could even be that crypto is an experiment in the making to see how the populations at large adjust to having this idea of a limited supply vehicle yet again. Gold is set up to have a lot of similarities now versus what the crypto environment is, but this could easily be used within accounting shenanigans to wipe out the debt problem going forward. It's not going to be an immediate thing, but I outlandishly suggest there's half a chance that gold could move anywhere towards $100,000 per ounce. Absolutely bonkers, isn't it? But the same was said about crypto at a similar stage. And what's happened this week? ZiG, Zimbabwe's gold-backed currency. It's the early stages. This is a game being played out, and I'm going to explain to you how that all could quite rationally take place. Hopefully you'll enjoy that, and we'll talk about any of these things during the live show. So going into this week, there's every chance that we're going to walk into some further consolidation. At the moment, there's a lot baked in on the indices. Gold's obviously had a pullback. The dollar, we talked on Friday about, possibly needs one more leg up, and conversely, the euro one more leg down. Japanese yen has broken out, but that, again, maybe in the midst of an expanded flat consolidation, in which case there is another small upside to UJ, and then potentially a decent pullback. That'll either be dollar weakness or Japanese intervention, or a combination of the two. We talked about earnings expectations. So yeah, bulls and bears are both looking at this as a consolidation wave 4 phase at the very least a 3-wave pullback. Some of them have had that, and then it's a case of does that develop and have further momentum to the downside from a 5 to a 10%, and then the doommongers will be suggesting a 25% end of the world job, whereas if you're bullish, you've been waiting for that pullback. Will it be bought? Is the plunge protection team in the background? They're not cutting rates at the Fed, but have they possibly got some of the POMO money still to put in? That's always been a support in the past. If we're involved in conspiracy theories and the craziness of it all, it wouldn't be a surprise to find out that there was some money at work in the background. Oil potentially, we said last week, is in a more bullish phase, and Citadel, who are a major player, were talking about tightness they expect to see coming through in Q2. And that is backed up to a large degree by the volumes held in tankers offshore, out at sea, are at record lows. So supply is getting tighter. Normally, you'd expect those to be all full and taken up. Goldman Sachs did a few bits of asset allocation tweaking, going overweight EU and short the US, overweight Japan, underweight emerging markets. We sort of suggested that was a Q2 trend likely to start, and it looks like it is happening. The CPI, PPI, we mentioned it, talked through it on Friday. That is a measure of margins for businesses, what are you selling for versus what it costs you to make. And it also helps feed through to PCE and keeps that under control. Williams came out with his comments post PPI, very much stating that they still thought that was the metric to look at. And also, in terms of bumps in the road, they're not unexpected. That's what they did expect. What they didn't expect was the rate of improvement and disinflation in 2023. So that's an interesting tweak to the narrative, just to keep the Fed on balance for moving either way, subject to data. Lots of chatter from equity analysts about the amount being thrown at defence and the fact that defence spending could see bonds issued to directly support defence spending. And that's expected to be anything up towards $10 trillion over the next decade. So it's very much this geopolitics situation is here to stay. That will be a factor that continues to affect commodities, particularly gold, with its geopolitical facets, as well as being a de facto financial, and it is a currency. And what a lot of people forget is that the gold was on a peg of some sorts for the best part of 400 years. We've only been in a 50-year situation with none taking place. So this is not new news. This isn't as crazy as people are trying to make out. We'll look at some of the indices where it appears that there are 5 waves in place, but on countback, some of those might not necessarily be valid. It's always important that the third wave isn't the smallest. And there's a very good case in the Dow that that's the case, in which case we are going to do a shallow pullback, which may have already finished, may do a double. We'll look at that in the charts later. So it very much looks like we're, at the moment, looking at the US only doing 2 rate cuts. That is probably November and December, straight after the election. I always thought that was the base case. It's now a case of can we get one in July or September? September, we've explained before, is a politically motivated one not to be, but don't rule it out if the data changes. So we get the Mag 7, as I suggested, we're going into earnings season. That will be a driver until it's not. There is a bit of argument going on in the space about just how good and reliable the technology is. But as ever, there's always someone in the background that's been working, beavering away with the next bit of tech, and that only needs another revelation to send this whole thing going to the moon again. So this week is important. This may well be the buying opportunity of the year. Remember, during Q1, we talked about having most of the return in the election year in Q1 and Q2. And if you've missed it, you'd be praying for a pullback. This is potentially what you've been waiting for. Sharpen the pencils. Let's be ready. We might have to go at any time. So CPI was the one that really derailed everything last week and brought us into this consolidation phase. That has become the new non-farm payrolls for impact. We've explained away NFP, non-farm payrolls, into being part-time jobs at the moment, so we can ignore that until that ratio changes. CPI is the one that we're struggling to get back under control, but it's at the margin. As I said last week, it was all the angst was due to the rounding up. It was only a 6 basis point miss to expectation, yet we've rounded it up to 0.1%. Does that make much difference? Well, if you converted that on a 12-month compounding basis, that adds about 0.5% onto inflation. That's pretty important at the margin, in my opinion. So it'd be better if we had a more sophisticated monthly measure and actually did it to the hundredths of a basis point rather than tenths. So not surprisingly, when PPI came out and was more in line, we managed to unwind a lot of that absolute nonsense. 20 basis points on the front end from a 6 basis point miss. Just shows you how nervous markets can be when they're in a consolidation phase. But that leaves us with the dollar now firmly as the highest yielding currency in the G7 and the G20. And that obviously attracts flows. That is creating this non-seasonal effect in April of the higher dollar for the moment. And as you can see from commentary from the ECB after their rate decision last week, they're at pains to say they're independent, but it is at the back of their minds. They're already in a weak relative position to the dollar, and if they are to cut early, then that only exacerbates that. And as I've told you before, weak currencies versus the dollar means that you're importing inflation. It's not necessarily something that you want to dive into too quickly. Commodities keep breaking out. A lot of that is based on demand. The oil situation, all sorts going on. I talked about the oil tankers off vessels in the sea being quite empty, but India also said that they've seen a pullback for demand, and they're the third largest consumer. So, it's forever moving. You've still got the artificial nonsense going on with Aramco and the Saudi Arabians. Take away the geopolitics, and it suddenly might not look as firm as it does. It hasn't really held on to the 90 level consistently since about a decade ago, I think 2014. So your history is against it, and we've mentioned before how we should be at $100 on WTI, really, where given all the background, I still think we're going to have to ride this demand-led phase, and it probably will go into low 90s, but just be aware that is still quite a tenuous strength in the background. So we started off with bank earnings in the States on Friday. We mentioned it in the live show. Not as explosive as we were hoping for. The net interest margins you'd expect to be better given the state of the yield curve. But what was important was the lower provisions for bad debts. So that takes away a few of the negatives that were building up from some people. It obviously won't make the data deteriorate quickly in order to get a rate cut, but it also means that the growth angle can push on. There isn't seemingly a disaster waiting around the corner. That's a helpful signal at the very start of earnings season. For impact, European banks are probably something we're more interested in because they're a much bigger relative play within the European indices. So that leaves us in Q2 with rates looking like they're higher for longer, pushed out. We've got the higher multiples already in place for the indices based on the Q4 earnings. Expectation is low for the overall period. So I'm being ghosted. The lights are coming on. which would be the slowest since 2019. So the market is potentially set up for it to be a soft earnings period, but I think I've got this feeling we're going to be at the top end again, and this will line up with the bottom of wave fours and see a further breakout. We're on the slate to have some of the big boys reporting this week. Goldman's and Charles Schwab on Monday carry on the financials. United Health, J&J on the pharma side on Tuesday. Bank of America, Morgan Stanley. In Europe, we've got Ericsson, the luxury side with Louis Vuitton, and the first miner with Rio. Wednesday, Abbott Labs, ASML, BHP Billiton, Volvo, Reckitt, Antofagasta. So a bit of a mining angle there, particularly copper, which has been the driver for some of this commodity breakout and the China pickup. So we'll see what the underlying companies are saying. TSMC gives us an update on Thursday. Netflix, who, with all the geopolitics around, I'm surprised there wasn't a Netflix trailer about the Iran attack. It was so well flagged. Another luxury, L'Oreal, Blackstone will be reporting, so we might get an angle on the M&A VC side. ABB in Sweden, we've got Danone, Investor, Nordea, and Nokia. So some of the Scandi big boys out in force on Thursday. Friday, Procter & Gamble for the staples, Amex, Schlumberger, Christian Dior. So it's starting to pick up in earnest on the earnings side. Data-wise, we have quiet Monday as usual. Just a little bit of European industrial data and US retail sales. That will liven things up in the afternoon. Tuesday, a host of things from China, GDP, industrial production, and house prices. So we'll get to see if there's been any continued bounce back. UK, it's back to wages and unemployment that were both helpful last month. Will that trend continue? German ZEW, even though we're consolidating, I think the sentiment will probably still be fine there. Canadian CPI, again, they're on watch, ready to start cutting, I think. US industrial production. CPI for New Zealand on Wednesday, and the finals in Europe, which shouldn't show any surprises. And then we've got oil inventories, which were surprisingly high last week. Thursday, Australian employment data and US initial claims. The FIDI Fed, which some people like for the PMI side of it. We've got leading indicators. So now we're so data dependent, we should be having a look at the forward-looking data rather than just all this 1-2 month backward-looking stuff. And US home sales, another leading indicator. On Thursday, Friday is Japanese yen focus with their CPI, absolutely desperate for a blowout figure, and UK consumer confidence and retail sales. Lots of talking heads as usual. We highlight in the pack what people said last week. I might go over that briefly towards the end. But yeah, a mixture across the board of talking heads all week. So just before we do the charts, a little quick mention of what I was talking about with gold. What was that absolute nonsense about $100,000 gold per ounce potential? Well, I've just got a feeling it's time to go all matrix, and is there possibly a crypto experiment taking place? So we've highlighted before how around the time of the gold standard, asset reserves in gold terms are always held 35-40% across the board. Then obviously, as everyone slipped away from that, gold holdings dissipated, were sold, went down to an average of below 10%. We've had this fiat currency experiment, which was fine in the first instance, but increasingly the temptation to just keep bailing out the system with ever more printing after printing hasn't stopped the booms and busts, and obviously now is creating inflation in the system. So all the negatives of having a gold standard with a fixed money supply and looking for the exchange rates to move around and potentially have control over the system, which stops inflation and deflation getting out of hand, people might suddenly be thinking, which is the worst, which is the lesser evil? And we've got to a stage where people are looking at numbers and they're incredulous. $34 trillion is the debt in the US. When they came off the Bretton Woods system, gold and the debt were more or less in line for a few years, but it's gone exponential on the debt side. There's a chart in the pack. And how on earth are we going to return things to normal? People have got the Armageddon scenario of how we're going to have to write off all the debt relative to each country and have an absolute mega depression again like the 1930s. But I think you've got to look at it the way that the fiat currencies have been manipulated. There is another way. QE is highlighted by helicopter Ben Bernanke and then enacted a decade later, was seen as being preposterous and was basically an accounting exercise. They magicked up money out of thin air by creating equal and opposite entries into the bookkeeping system. And this is the key. You have to keep balance sheets in line. Every time you increase on the asset side, there's an equal and opposite liability. What has happened before and is likely to happen again is the creation of a gold revaluation reserve, particularly as at the moment, gold is particularly moving. All these people sat on gold, and in the US case, I think it's down at single figure dollars where they own or they've got their gold valued. At some point, there'll be a gold revaluation reserve, and how they'll manufacture that is by selling it and buying it back at high levels. China, I mentioned it on Friday, has way in excess of what the official reserve number is. So their official reserves are 2 tons. The US have got 8 tons. But crucially, China is the biggest producer of gold. Since 2000, they've been telling their own people to buy gold. And being the biggest producer, they also ban exports. They've been massively importing. They've got all the purchases that are done domestically and by not just the central bank, but a lot of their other state agencies also do a lot of buying, and they don't sit in the exact numbers. So all told, there's some very credible analysts have added up the control factor that China actually has on gold, and that adds up to something like 30,000 tons versus the Americans 8%. Now the Americans generally distrust their government, and anyone that owns it or companies are very unlikely to pledge their gold to the US state unless something strange happens. Whereas in China, in surveys of the public, 99% have suggested that they would back a national interest project if they were asked to do something with their gold. So there's the potential for China at some stage to certainly look at a gold standard, which will obviously see demand for the yuan going forward be strong if the gold is valued in it. Initially, there'll be a massive boost to people's wealth from selling yuan to convert into gold. But this will be interesting to see where this all manifests and whether there's some combination going on, whether individuals just happen to have come to the same conclusion. But there is now an inbuilt reasoning to potentially make gold settle at really high levels or be pegged at high levels in order to create these revaluation reserves. And once you've got that bubble on one side of the equation, you'll be able to write off the debt on the other side. So that is something that's possibly at play. Europe have gone to the lengths of reorganizing or encouraging countries to reorganize their holdings of gold in proportion to their GDP share in Europe. And apparently lots of people, when they've been asked, have been given it the classic no comment. And remember, 4 to 6 weeks ago, I made reference to how I think it was Nagel, a Buber, when they were criticised for their loss on the year at the German central bank. It doesn't matter. We've got so much gold, it doesn't matter, which he sort of probably erroneously revealed. So there's a plan in Europe to try and do that bailout. America, very coy. All the economists and central bankers very dismissive of this policy, but we'll see how things progress. Now, crypto, where did it come from? Who actually started it? Do we know? And that's very much an experiment of a limited supply, despite the fact tons and tons of different ones keep appearing and meme coins. But the underlying premise, if you had one cryptocurrency with a supply, and ironically can only be mined, just like gold, you've suddenly got, you can see the potential. Look how that has gone from hundreds up to 70,000 already. What is to say that gold, if it is used and pushed forward as being a similar thing with an almost, as we know, being in super cycle at the moment, a fairly restricted supply. What was a criticism of the gold standard was that you couldn't grow gold supply quick enough to keep up with growing economies. However, since the 70s gold standard disappeared, I think 50% of gold produced ever mined has taken place since then. So this thing, despite being in super cycle, has managed to find it, better processing, etc., etc. And we talked about things like FMET, cleaning up tailings. There's a big potential extra supply coming from that. So you've got ZIG, Zimbabwe, already pegging it. I think I saw over the weekend Dubai have created golden notes, so that there is the wherewithal to create some kind of golden currencies going forward, and we're very much at the early stage of that. So I'm presenting to you the fact that there's a move towards it. There's a reason for the prosperity and survival of nations to find a solution to this out of control debt situation. And what do the numbers mean? How on earth do I get to 100,000? Well, that comes from the fact that the US at the moment, they're 8,000 tons. That equates to about 0.6 of a trillion versus their national debt of 34 trillion. So it'd be 56 times that amount required to totally match. Now, obviously, there'll be some kind of quotient below that where they'd be happy and the world would be happy to see, but it shows you that there's an absolute desire to try and sort, on the basis the US is this out of control, 99% devalued reserve currency. I think a lot of people would like to see a high proportion of that somehow brought back under control. And when you say that's preposterous, that'll never happen, just remember what people said about helicopter Ben Bernanke saying, literally, if we need to print, we'll fly around in helicopters throwing it out of the window. And we've seen how that has started to end up. So don't rule it out. And that is a kind of thing that you'll see more and more people talk about to varying degrees. So it could, well, we're talking about people just getting a handle on what they call preposterous numbers of going through 2,000 up to 2,300, 400. More and more people are talking about the 3,000 in line with inflation since the 80s level. Well, that might just be the very first tentative steps to something that is crypto-like. So you heard it here first, or maybe not. So gold itself, from that chart I said, we've got the trend channel in, we've pulled back and we've opened today. There's every chance that could do a double, and we might have to draw that differently. There's every chance that third wave there is not the same, is not at that degree. It could be at a smaller level, or it could have started collapsing in at the high degree. It is a 5-wave move. We just got to work out what it is. But, why fight the chart? Why fight the tape? We're in this minute degree working up for what we said was the minor third wave, working from down here all the way up to the top of that channel and the one spot 618 level. Lots of confluences suggesting that 2550 is going to be the eventual top of this range. So do we expect the fourth wave within that to come out? I mean, it's been a fairly deep wave relative to the last move up, spot 786, and that could well be the fact it's it may well be a 2-wave within a lower degree structure because of that, because we'd like to see the fourth waves stop at spot 382. we'll have to keep an eye on it. It could end up being a spot 382 of a much bigger degree. But what I do think is it's not the end of the move, and we are going to keep going up. It may be that we're about to enter into a new channel. That's very encouraging this morning. We've got the bounce up. People are going to be telling you it's because of the geopolitics. I think the geopolitics took us up to the top of the channel, and then the people in the know took away the geopolitic premium. And now, hopefully, that sorts itself out. But it might be a double correction to sort itself out. We'll keep an eye on it. But we've still got a lot of deep support here. It was interesting how the higher up support, and they were quite thin bands, just got totally washed away. And again, on the MACD, we've got a relative high here. That normally suggests, as we've been talking about, that it's probably a third wave, and putting in a fifth wave may well be a lower overall momentum. So I have the Dow. I've got a couple of charts on that, so you can see how this has probably been the one US index that is really leading the sell-off. But just looking here, it very much is approaching a 1-for-1 on the pullback, which has wiped out all of Q1's gains, more or less. If you look across, potential for an equal legs already, or very close to it. Wave 4, the move to a new high, and if that were to go to above the March highs, early April highs, we've got quite significant upside. Looking at it on the weekly basis, we can see a point within that, and the reason why there could be a lot more highs is there are 5 swings up to this high since the October 22 low. We had we had pretty much a 3-swing sideways movement, which could have extended, other than the fact that the October 23 low would be truncated. Don't like truncations. As a flat, they don't really exist very often. So that tells you more or less guaranteed that was a genuine too low after the banking crisis, the SVB crisis in early March 23, which makes, if you'd carried that on, we've had a 1 up, a consolidation, another 5-wave move up, a consolidation, and then the final 5 waves up to this year's high. That leaves this middle wave as the shortest. That can't happen in Elliott waves. That means this move up to the 24 highs, the all-time highs, is an incomplete structure that's had a 1, 2, and a 3, which leaves a 4 and a 5 to complete it. So it's all okay. And then if you remember that 4 can't normally overlap into 1 unless it's normally a diagonal, and it would be an ending diagonal, which would be a wave 5. This suggests that the pullback should be fairly shallow, should hold 35,726 really. I think it's unlikely to get there. We may have already put in the low, or maybe within days of, even if things were to carry on falling, I think there's a good chance that this spot 382 classic 4th wave pullback is where we may be going, and then put in a new high. Again, some would argue that you've been doing an ending diagonal, but again, the fact that the 3rd wave is the shortest and that they're not following any real kind of pattern to it, I think we should look at this as being a continuation of an impulse move up. And by the fact that we're doing an extended 3rd wave, we'll have a 4th wave pullback when that finishes, and then have another high again. So there's at least 2 more highs coming on the Dow, I think, before we get any kind of properly significant pullback. So the S&P 500, that again, we've moved the trend channels a couple of times. Looks like we topped out on a wave 3. And again, it's a shallower pullback than the Dow. Yeah, and already we've hit a 38% pullback on the fib in what looks like a previous strong support zone in the wave 4 at the lower level. And then it's all about how do you interpret internal mechanics breaking down. So we've kept this on throughout the Q1 and Q2 so far on the S&P chart, which is the percentage trading above or below 50% of its 50-day moving average. It's been positive all the time until this pullback. So it's how you interpret it. We're at -9. which is, I think, it makes it 41% of the S&P 500 is trading above its 50-day moving average. Total collapse. So is that a confluence of an equal legs pullback on a 38 fib at the edge of a previous wave 4, and now is that a capitulation move, or is this telling us that the internals have totally broken down on the S&P and we're going to get much more downside? I mean, given what I've said and what I'm expecting for earnings, I'm leaning more towards it being certainly in the process of the end of capitulation, and look out for a reversal that takes us to new highs. We looked at the dollar on Friday's live show on the weekly basis, just to give everybody the idea. So it's in a long-term uptrend, which put in a third wave top at the end of the sell-off into October 22 lows. Since then, we've been putting in a three-wave ABC fourth wave, and we thought we'd very much done the A down into March 23, which then did an expanded flat correction ABC to give us the B high in October before the dollar sold off. And then we were looking for 5 waves down. We'd put the one into the January lows. We've had numerous attempts at finding the top for the consolidation minor wave 2 up. And we thought the seasonality would potentially make that break and various other things. But we've got this strength. We've got the pushback on rates, blah, blah, blah. So it may be that we have to interpret rather than being an expanded flat, that the whole move down to the July lows was the A wave, and that the B, we were actually still within the B wave itself being a double correction, in which case we've highlighted how we don't really want it to go too much higher, but unless it takes out the highs at 114, it's still valid in anywhere in there to still be putting in the consolidation to then have eventual lows. But I'm leaning towards this running out of room, seasonality to come in, data to possibly help, something to happen to make this top out pretty soon. It's looking quite extended. We talked on Friday, 108 might be the ultimate equal legs of that A, B, C. It's just something to keep an eye on. But very much looking at, we're going to look at the euro dollar and the Japanese and the UJ in a minute. It very much looks like we are close to the end of the move. So it doesn't really add anything on the daily. The same idea. Oil, I presented last week that it might be a little bit more impulsive with a cycle 1 and 2, intermediate 1, 2, working its way up to a primary breakout. And we're just in the minor waves here. Geopolitics perhaps subsiding. Do we get that little pullback into low 80s before we put in the fifth wave? It can't really go much above sort of 93.4 unless we've got an extending wave 3 happening. We'll have to evaluate that when we get closer, but it does look like we're set up for a bit of sideways movement and another breakout high, really. Again, the momentum for this is waning a little bit. So the next high may well be at a lower momentum. When we last looked at the euro dollar, we thought we were in a 1-2 scenario. And we said we were looking in here for a turnaround from a 2 low and breaking out. What looks like has happened is that we're doing a WXY consolidation for the wave 2 to be much lower as the dollar tops out. And what that breakout was actually was a connector, the X and ABCX. If we're looking at equal legs, W equals Y, we're dealing with the black lines here, and that gets us down to 1.062. And if we're looking at it in terms of the actual Y leg that we're in at the moment as an equal legs ABC, that gets us down to 105.70. So somewhere in between the two of those is probably where we're going to finish. Got all the 3 ending waves labeled down there, but it's going to be somewhere in this zone here. It looks like there's one more low to come. UJ, we had the 152 line in the sand previously an intervention level. So we had a reversal, change of character, change of setup, change of trend. When that came in, and it came all the way down to this 128 low at the start of 2023. And that was a continuation of something that happened a number of times and has happened for the last 2 years, which is a January trend change. Often happens in currencies. But what have we had? We've had a clear 5-wave move up here to challenging that intervention perception level, I called it. So that would be an orthodox top for 5 waves. You'd expect then a 3-wave consolidation. As it is, we've put in a new high. Now that overthrow can happen in a consolidation, and it's called an expanded flat. So you get an initial move down, you get an overthrow to a new top, and then that, in order to be valid, then means that the last leg sell-off will take it to a new low below the previous swing low. So that's what we're looking at. Now, I've put a line in where the 155 big option volume line in the sand is. Do we actually get there? How far will that breakout be? 155 surely will be a new area where they talk a lot, and by the time we get there, we should be into next meeting or approaching it. We'll have had CPI in Japan. Will they have the wherewithal and the ability to change the rhetoric and start to talk the dollar down? And will the dollar in itself have added to the party? So if we get a double whammy, it's, we're heading back towards that 140 level before we'd then resume the upside. And that very much may sit with the dollar putting in its ABC finish, the end of the wave 4 it would be, wouldn't it? Before we carry on to the final high breakout wave. Missed out Germany. Germany is interesting. We've been talking about its underlying strength of late. The euro debacle has messed things up slightly. We mentioned during the live shows about being a double correction. We put a connector in when we thought we might have had a 4th wave low. Since then, have we done enough subwaves to get there? There's potentially a 5 swing or potentially a 3 wave. So this may well be a connector here before we're putting in the final 5 waves here. Or it could all be over. That possibly got enough swings in it, and it's got an ultimate new low in place as of Friday. So it's very complicated. Could have a tiny bit more downside to come. But again, we should be off to new highs. And we've got the equal legs in there. It's already hit the equal legs for the connector induced final wave. So it looks like it's a prime time to buy. It's just whether we manage to get a small extension during the trading this week. And then the final chart I wanted to look at was the Nikkei. And again, that has the strongest underlying characteristics anywhere in the world. In the upgrade cycle we've talked about, obviously the potential weakness of the exporters has been anything but, because the exchange rate since the hike has gone the other way. So that's another potential positive. Again, we look to be putting in a double correction, an ABC, W. We've put in a 3-wave connector, and we're now working down another ABC, and we're in the final throes of that. So we've had 1 or 3 down with a 4th and a 5th to come, or a 3rd and a 4th and a 5th to come. Equal waves again of the W and Y takes us down to 38,344. Within the Y leg, equal waves takes us down to 38,458. So where are we? Looks like we're within around 1% to 1.5% from a classic reversal. Any of these could put in a series of short waves to complete the structure, and off we go. I do really feel like this is the time to have a go on buying into any renewed weakness, if not catching the uptrend if we move into it pretty soon. But Nikkei for sure we should be buying. DAX quite likely we should be buying, and obviously in the US, take your pick. Nasdaq is going to be quite exciting. That's been the shallowest. The S&P, that's at real extremes. The Dow has been the biggest mover. They all look like they're in the realms of having done enough. This should be the Q2 period where we've got the 3, 4, 5 heaven. It's about possibly being brave into this wave 4 now. So that's really all I want to talk about. I'll go over it again in the live show and answer any questions. Obviously, if you're watching this out of sync with the live show or it's not out in time, then please come in for follow-ups. I'm pretty sure you'll have something to say about the crypto gold analogies. But anyway, be careful out there. It's tough in the wave 4s, but we should really be looking to buy the third waves or the swings. 3 swings or the connector 7 swings is where you should be definitely picking up a lot of these moves, unless we get some fresh negative news. But I pretty much think a lot of it is baked in. So good luck with your trading. We'll speak soon. Planty out.